Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So this time, it's not like the time of year, but like based on everything that's going on, it's a great time to do tax loss harvesting for your taxable investment accounts. Lots of things are down. Great chance to sell, realize that loss, move it to some alternatives so you stay invested, maintain your asset allocation, and that loss provides a reduction of your tax bill come next spring. And so, again, this is a good, hey, markets are down, financial advisors, can't do anything about that, but here's that silver lining of some action we can do that helps our clients. And it's one of those things where it's almost universally agreed upon that this is a good thing to do. But if you've listened to Trishul and I talk in the past, you know we can't just let that blanket statement lie. We have to go there's this little caveat here, and there's this counter to that caveat. And as soon as we kind of got too back and forth, you know what? We should have a full conversation about this and go through all the nuance. So today is less about the mechanics of tax loss harvesting. We've done that in the past, although I'm sure we'll bring it up again. But it's kind of all the theory and nuance about tax loss harvesting is good, but it is not the greatest thing ever. It's there's on the spectrum, it's better than not doing it, but like many other things, it can kind of easily be sold by financial services companies when it's a good thing, but not as just clear cut automatically the best thing ever. So Trish, why don't you start off with just a couple examples or a little bit of data on some of the tax loss harvesting you've done recently with markets being down.
Right, yeah. So markets are off about 20% this year or so. We're towards the end of June here when we're recording this conversation. And yeah, the high level notion is markets are down. What are you supposed to do? And, it's one of the main things that has come up, for example, in conversations are what do advisors end up doing when markets are down? How do we handle this? And a common theory might be that, we're adjusting, we're zigging, we're looking at economic. We've talked a lot about how we're not doing that. We're not trying to predict where things are going to go or change up strategies and stuff like that.
Good old rebalancing takes care of the asset allocation.
Right. We'll do the rebalancing, and then there is an opportunity to harvest tax losses. And we've spoken about this a handful of times. We did a whole episode on the intricacies of it. But very quickly, the 30-second recap is when things are down, some of your positions may be at a loss. You can capture those losses by selling out of those positions, and you can offset future gains. Now, there's many rules on how you can do this without having to basically sit on the sidelines with your position in cash or change to something that you don't want to be in. And the reason for this is because there's this big concern called the wash sale rule, meaning what the government is saying is if you sell IBM for a loss, you can't immediately buy it back a second later and then start getting the gains from it. Those losses that you captured from that loss, if you buy it back immediately, they'll get basically undone.
The losses are disallowed if you buy back in within 30 days.
Yeah, so there's a 30-day window. So that's thing one to keep in your mind, which makes this tricky. Thing two is technically, if you sell IBM, again, you're not supposed to buy IBM directly again. However, let's say you have an exposure to a certain market, which is like the S&P, call it S&P A, and that goes down because the markets are down. Now, you could sell S&P A and you could buy something similar, but not exactly the same as S&P A, call it S&P B, S&P
I
B.
prefer to think of an example of you sell the S&P 500, which is the U.S. large cap index, and buy the Russell 1000, which is U.S.
Sure.
large cap index.
Yeah.
The performance and risk is be almost identical, like 98, 99% the same, but they are definitely not violating wash sale rules because they're different indices.
Right. So you can do that without having to wait the 30 days and still maintain the S&P exposure, and you still get to use that loss that you just locked in. And that's what we're trying to do here, because when markets are down, it's a great opportunity to collect these losses across your accounts that are in taxable positions. So we're talking about the accounts that aren't in shelters like your IRAs or your 401ks and stuff like that. No, we're just talking about your standard taxable accounts here.
That's
So
a good point. So
yep.
it's again, kind of asset allocation is still the most important thing. Maintain the right mixture of stocks and bonds. Can't do this in retirement accounts, Roth IRAs, 401ks. There's no benefit of making these types of trades in retirement accounts or the tax deferred accounts. So it's how do we, one, maintain the asset allocation in our taxable investment accounts, but also take advantage of these losses to help our taxes.
Right. And, the nuance here is, let's say you bought the S&P at $100, it dropped to 80, and then it went back to 100. Well, you're kind of where you started. Nothing major happened if you didn't do any sells. However, if you buy the S&P at 100, it drops to 80 and you sell it, and you buy the Russell, let's say it's also 80 magically, and it goes back, the Russell goes from 80 to 100. Now you're still holding on to the Russell. You haven't sold it, but you have this $20 loss on the S&P that if and when you end up selling Russell, you could offset that. And the main point here is, let's say you hold on to Russell for the next 5, 10, 20 years. Well, those gains are accumulating off of a lower base, in this case, $80 instead of 100. And you're not paying taxes on that extra $20 benefit until you sell.
Okay, so you, in that first year, you had a $20 loss that, if it was short-term, can either offset other gains, could use it to offset ordinary income up to $3,000. This can actually reduce your tax bill that spring. Okay?
Right. And that could be real money in your pocket today, right? And potentially the long game of this is, let's say you hold Russell for like 10, 20, 30 years, and eventually, if you pass away, the Russell shares get a step up in basis, so those taxes actually never get paid. Now, instead of the taxes that you would have had to pay for, buying the S&P at 100, now you ended up buying Russell at 80, right, in this example. So you got an extra $20 of tax benefit, essentially, because you held it for so long and you got that step up in basis at the end. Now, that's the ultimate way to reduce your taxes, right, or maximize your benefit from the strategy. However, you could just sell the Russell 1000 after many, many years, maybe even decades, and you're still getting a benefit there, even though you'll have to pay taxes on that incremental $20 eventually. You're deferring the payment of those taxes, meaning that $20 continues to compound in your pocket, and it can grow tax deferred. And over time, that does end up being a substantial benefit.
Okay, so why don't you go and share some examples, and then we'll come back, and because that was a great explanation. That was all we got, all the theory in there, and we'll give our listeners kind of time to think where you and I are going to kind of explain the caveats and nuance. But why don't you give some examples of some of the actions that you've been able to help clients with?
Okay, so the year started off rocky from the beginning. The S&P kind of topped out towards the end of December, but basically ever since January, it's kind of been falling. And we've noticed this before. And essentially what happened is around March, it was down, like 10 or 12%-ish. So I did a first tax loss harvest where across the client accounts that are with me, I harvested losses. And that time it was around 120,000 or so. And what that means is those were the total losses that we were able to accumulate in my clients' accounts. Now, some of these losses were short-term, some of them were long-term. So the benefit that a client will get will depend on their short-term tax rate, marginal tax rate, and the long-term marginal tax rate. Using a rough estimate for short-term and long-term, this will differ depending on where you are because there might be different state taxes to consider here. But if you're just talking about the federal level, roughly on the short term, if you're making about 150 to, was it like 300,000 for a married couple, it'll be around 24% on the short term. And on the long term side, it would be around 15%. So that's a good median number. If your income is higher, it'll be higher than that. If your income is lower, it'll be lower than that. And if you're in a state like California, it'll be much higher than that. And if you're in a state like Florida, it'll be lower. But, just using rough estimates of 24% for short term across all these clients and 15% for long term across all these clients, the actual total savings in tax for this year for this one maneuver would be around $24,000 across these. This was like 7 clients.
Yeah. Yep. So we've talked in the past how I use SCI, and I use them especially for their tax management program. So I have clients who both have ETFs. I also have clients who have some form of direct indexing or kind of a managed account version where we have individual stocks that are looking to do the tax loss harvesting. And very roughly across different accounts, their asset allocation matters, the when they invested matters. But I've seen somewhere between 3 to 10% of the account, the SEI and the different programs that they use have been able to generate losses on the scale of 3 to 10% of these taxable investment accounts. Again, some of the programs have just more in bonds, and the bonds aren't looking to do the tax loss harvesting. Some of the programs are more in equities. So it kind of depends on client age, client risk tolerance, client asset allocation. But again, these been a good spectrum of about 3 to 10% of these accounts have been losses. And if you apply, again, very roughly, for residents of California, I'll say a 25% federal tax rate, a 10% state tax rate might be something like 24 and 9. But for these estimates, I think a kind of very rough 35% is close enough. And so again, we're saving a third of that. So we're saving on a scale of 1% of the 1 to 3% of the portfolio value in actual tax savings. So for a client with $1 million, we're saving somewhere on the scale of $10,000 to $30,000 on tax savings this year, or like in the next couple years, depending on their other income and how losses carry forward. So again, this is kind of the scale of, I mean, the markets are down, that's not good, but this is almost like a best case scenario in terms of seeing how these tax loss harvesting programs play out. And this is consistent. I saw the same thing going through 2008. There have been other years in between where I think it was 2019, 2018. The S&P was flat, basically. Like it was almost like exactly 0 or 0.1%. But there's enough volatility to also generate losses. March 2020, we also saw enough of these tax loss harvesting. So again, this is one of those things where the theory plays out. It kind of makes sense. It's not a data mining kind of strategy. It doesn't work every year, but it does work when they're down years. And so that's what I think is capable, where over enough years, again, depending on how big your data set is in terms of how far you go back, these programs tend to average about 1% of the portfolio in tax savings. So some advisors kind of say, like, if nothing else, it makes up for the fees that they charge. And these programs are the ones that SEI are charging on the scale of 20 to 40 basis points, depending on account balance and which program we're using. But these programs really do work. And for my clients, especially when they have large company stock positions that have a lot of unrealized gain, if we're trying to sell it, they're paying really big capital gains bills. This is the type of thing that can directly offset those capital gains. And so for enough of my clients, they don't necessarily have to wait to see that tax savings. They often get it in that first year. So do you have any other kind of quick examples or data points that you think of when it comes to tax loss harvesting and how it's played out this year?
Yeah, it's interesting. I just did some back of the napkin math. So I did 2 rounds of tax loss harvesting. I did another one in June as well. And yeah, on the first one, about 100 and saved about 24,000 in taxes for my clients, and around 43,000 the second time around. And roughly on like a let's say for these set of accounts, it was like $7 million ish. I don't know the exact number, but that's a good ballpark. It comes out to about 1%, right? So it's roughly in line with what you had mentioned. And the notion is, it's something that a lot of research says it's sensible to do, but often it likely may not get done in practice if left up to just an individual. For example, I've known about this over most of my working career, but I've only actually implemented it when I've had an advisor myself do it. And it's something that also, frankly, has matured over the last decade or two, meaning it started off as more academic, and now there's a lot of progression in how it's flowed through market products, and it's a lot more common now. So it's something where the technology has caught up with the research and the tools are there. Maybe it's still a little tricky to do as an individual. You kind of have to, I remember figuring out how I might do this a long time ago, like in 2008. And it was literally, spreadsheets and positions and tax loss and lots and all that. And, a lot of calculator stuff to get it right. But, that's what computers are great for, right? The automation and calculation part of it. So it does make it a lot easier now that there are all these different tools available to make this happen.
I remember, so kind of like the way like market products have played out, the way you're describing it. Parametric, one of the companies that I use and have used in the past, they have been doing the tax loss harvesting for several decades now. Again, they're doing it at the individual stock level, but they have been a separately managed account. So their fee has been on the scale of 0.7 to 0.9%. So again, like that 1% tax savings is still greater, but they had to do it manually, basically, just like any other actively managed fund that's picking stocks. Now, again, they were prioritizing matching the index and prioritizing the tax loss harvesting and then looking at tax lots. So they did a really good job at that, but the fees were higher. There was also early when I started at my prior firm was 2008. And I spent a lot of the end of 2008 and 2009 manually doing tax loss harvesting for all the clients at my prior firm. I was close to my full-time job for like 6 months. So again, like trying to let track, I need to download every position and every taxable account, which ones have losses. Okay, now I need to enter a bulk trade. I'm going to sell out of this fund across these 150 accounts, and I'm going to buy in with the proceeds, buy into this fund across those same 150 accounts. And again, the tax savings were worth it to my clients, but again, that was my full-time job at my firm for about 6 months, making sure that that got done correctly. So again, I have a couple clients who still want to manage their investments themselves, and they're doing fine. But I had to remind them, hey, now's a good time to go look at this. It's not going to be at the same scale, and that's what technology has gotten to today. The direct indexing program where we can use technology to buy the individual stocks and look for the tax loss harvesting and keep the fees down below 0.4%. The technology's only been around for a couple of years. So this direct indexing, where it's entirely passive, algorithm, computer-based, wasn't around in 2008. It had to be done manually at that point and done with higher fee, and the fees were higher. So that is kind of one of those progressions of either you had to do yourself and pay a lot of attention and make it almost a full-time job, or the fees were higher. And so now between enough competition, especially at like companies like Betterment and Wealthfront at the ETF level, that they have gotten the technology to be pretty good. The fees have come down, and I think people in general are benefiting. They're getting the tax loss savings pretty consistently. And again, but it just wasn't there 10 years ago. So yeah, trying to do it manually versus automating it, that's a relatively new advancement in investment technology.
Yeah, and I think it is worth actually being clear about that one distinction that you said, direct indexing versus the ETF model. So we did talk about this a bit before. The notion is you can have your exposure, your market exposure across various ETF indices to represent your allocation, but you can even break it down into the individual stocks. And that's what direct indexing is all about. And the notion there is you could directly have, for example, all 500 or a good approximation of all 500, a statistical approximation, that is. It might not be all 500, but close enough, good enough to.
I think they've shown it takes about 150 stocks to come across the sectors where you both can almost identically match the risk and return. So you get same return, same volatility, but you also have an alternative for every stock. So I've been using the example, if you sell American Airlines and buy United, you can't own both of those at the beginning. Like you have to kind of choose your allocation to the airline sector. But yeah, they can match the S&P 500 with about 150 stocks.
Right. So instead of having, maybe one ETF, in this case, the S&P 500, and that goes down and you get the tax loss on that, you could have 120 different opportunities. Now, each of those opportunities is smaller, right? Mm-hmm. However, you may end up with more opportunities statistically to take advantage of. So there is a slight benefit. And the big trade-off in the past was, well, this is possible, but it's more expensive to do because you got to handle so many more moving parts.
Yeah.
And we are seeing a good change in the market where price pressure is bringing those costs down. The other thing we're seeing as well is we're seeing the fractionalization of shares, meaning, if you want to hold, for example, Berkshire, you need 300,000. Well, how are you going to have like 120 different positions where you have certain ones that are so huge, right? Well, with fractional shares, you can buy like 0.2% of a share of, all of these 120 stocks. And then without having a large account size, you can still do direct indexing. So previous minimums were in the couple 100,000 range, and now they're actually dropping down considerably.
Yeah.
And so are the fees. So I think direct indexing is coming in line with the standard tax loss harvesting off of the ETFs when you compare both on an after-tax, after-fee basis.
Yeah. And like a super small thing, when you do the direct indexing, theoretically, the technology to run a tax loss harvesting program at the ETF level versus the stock level, the technology should be the same. The computer kind of doesn't care if you have 12 positions or 150 positions. The algorithm's like, is this position at a loss? What's the alternative? Okay, sell this, buy the other one. So again, theoretically, the tax loss harvesting program, those costs should be the same. But with direct indexing, you can actually kind of remove the ETF expense ratio, the fee that Vanguard or iShares charge to create that wrapper of stocks. You can start to remove that. But again, that gets back to the kind of the fractional shares issue and minimums, where the direct indexing isn't quite there at the fractional share level yet, but it feels like it can probably get there pretty soon. And so, whereas the ETFs have done a really good job with that. You can put it $1,000 into an S&P 500 ETF and get exposure to all of those ETFs. And again, Vanguard's going to charge a couple basis points, couple 0.0%, 0.01 to 0.03%, to be kind of create that wrapper. And that's the thing you can start to cut out. Large cap ETF expense ratios have gotten down really low. Small cap's a little higher. International still a little higher. So international is on the scale of 0.1 to 0.17. Emerging markets kind of on that scale. So theoretically, direct indexing can also help eliminate that ETF expense ratio. Again, it's not enough, whereas I would say like you need to avoid ETFs and go with direct indexing no matter what. Like, there's still a lot of benefits to the ETFs, but at a certain scale, if we're trying to kind of eke out these marginal benefits, that's another tiny benefit of direct indexing.
Right. So you did bring up one point. So I think we're also seeing evolution in the amount of markets that are covered by direct indexing. I think primarily it's been more large cap US focused. So I think we'll probably see more of an expansion, internationally and across, smaller position sizes in the US even. But it's my understanding most of these are domestic US. Have you seen any international direct indexing going on, Aaron?
So SEI has done a good job. They have a large cap, they have an all cap for the US, and they have an international developed.
Okay.
But they do not have a small cap specific, and they don't have an emerging markets. So
Right.
that's kind of, you can do it with that all cap, and that'll still match your asset allocation. Again, because you're going down the individual stock level, they can also rebalance between large cap and small cap pretty well. But they don't have it for the emerging markets yet, and so yeah, you're right. That'll be also the next step of, okay, we can start to introduce this tax loss harvesting at kind of more asset classes.
Right. So, frankly, in my mind, it's good to see the industry evolving and creating products that are designed from the ground up to provide a benefit. That these aren't things that are trying to be the next big thing, or they're not necessarily speculative. They're just theories that are backed by research, that are founded upon structural ways that the markets are implemented. In this case, it has to do with the tax code.
Mm-hmm.
And the products that we're seeing and the evolution that we're seeing are just trying to make or take advantage of these structural components of the markets in a more and more efficient manner. And that ends up being passed on, given the amount of competition in the space, onto the clients, which I think is a good thing.
Yep. Okay, so let's go back to the kind of the initial premise. We've done a great job. Technology is getting great. Fees are coming down. tax loss harvesting is great. Now let's start kind of exploring all the components of the theory that you laid out and where some of the nuances to help people better understand. This is really good. It is not a free lunch. So when what was I'm trying to remember, what was the first thing you said when I was trying to describe, like, oh, this is definitely the greatest thing? Some of these tax savings are really, really helping my clients.
Well, okay, so it's not necessarily a full tax savings today, or it is a full tax savings today, but eventually you got to pay that tax savings back. So it's more like a tax deferment.
Okay, yeah, that's right. Okay, and so here it's kind of the kind of three things I think of. It is a tax deferment. Yes, we are lowering your basis, and if we sell out of that investment, you'll pay taxes on that lower basis. So we might be increasing your capital gains taxes at some point in the future. I acknowledge that. Okay, we are getting the tax savings now, but if we sold everything at some point in the future and our tax rates was exactly the same, then we end up paying the same amount in taxes. So my kind of three counters. One, we don't know what your tax rates will be in the future, but it's a realistic possibility that if you're working now and you're not working in the future, that your tax rate could be lower in the future. Or at the very least, you can, if you don't have any earned income, you have a little more control of how you pay your taxes in what calendar year. You can coordinate your investments with your Roth IRAs and your traditional IRAs, and like, okay, 1 year I'm going to have a higher tax rate, but the next year I'm going to have a lower tax rate, and so I'll do maybe it's Roth conversions or kind of more of the selling in those years and paying lower capital gains taxes. So yes, if you just do a tax loss harvesting and sell everything in the future, we'll try and see if we can get a tax savings now at a higher tax rate and pay the taxes in the future at a lower tax rate. It's actually the same idea with using a Roth. If you have $6,000, do I put in a Roth, or do I pay the taxes and put in a traditional IRA? If your tax rate's the same and you only have that $6,000, you'll net the same amount in the future. Or the other way around. If you put $6,000 in traditional IRA or pay $1,500 in taxes and you put $4,500 in a Roth IRA, and then they grow at the same investment rates and your tax rates stay in the future, you take money out of the pre-tax IRA at the same 25%, you'll net the same amount. But that there's value in the tax deferment, and there's also, like, we can try, I don't say manipulate, but we can coordinate and plan out what your tax rate in the future is once you're no longer working. So that's kind of caveat number one to your counter that this is tax deferment. Two is one of the things you mentioned. Under current tax and estate law, when you pass away, you get your beneficiaries get a step up in basis. So I think you made use of something like this is tax deferment indefinitely. What was your phrase again?
Yeah, ideally you want to defer taxes indefinitely.
Yeah, so this is tax deferment, possibly indefinitely. But when you're doing the action now, you can't know what your estate will be years down the road. But yes, based on current law, with the step-up basis in place, you could defer taxes and then never pay that. That is a possibility. And that step-up in basis is something that comes up in political conversations every now and then. So it's possible that goes away a couple decades into the future. But as of right now, if you lower that basis and you don't sell out of that investment, whatever's left over can pass to your heirs without paying any capital gains taxes. So it is, again, theoretically possible to defer this forever. But I think the more important thing is actually a time value of money conversation, where I think you also mentioned this. When you save money on taxes now, theoretically that is going to stay invested and grow. It is better to have money now than the same dollar tax savings in the future. A dollar of tax savings now is worth more than a dollar of tax savings 20 years from now. And as much as we can do to reduce your tax bill now, you'll likely end up in a better position. Now, again, realistically, you start to play like, are you saving and investing that difference, or are you spending it? And that's kind of a different part of the conversation. But that time value of money component is a real factor. And so when you think of those three, acknowledging, yes, tax loss harvesting is kind of more of a tax deferment, but between potentially different tax rates in the future, potentially step up in basis, and the time value of money, do you want to expand on any of those, or do you want to add anything?
Yeah, I was actually thinking of the time value of money component myself. It's a little obscure, but I think one way to kind of play it out is back to my very early example from this conversation, that $20 tax deduction you were able to take today by doing the tax loss harvesting that you wouldn't have been able to do, right?
Mm-hmm.
Well, let's pretend that saved you literally $20 in taxes. So instead of sending $20 to the government, you have an extra $20 in your bank account today, right?
Mm-hmm.
And you took that same $20 and you invested it, and it gets to grow. And it continues to grow and grow and grow and grow, tax deferred. You're not paying any taxes until that $20 finally gets sold. And yeah, ideally, that $20 grows indefinitely. I don't know if I should say ideally, but optimally, that $20 gets the full step up in basis, meaning it never gets taxes paid on it whatsoever. Meaning you just got $20 tax free, growing over. If it's 10 years, that with a 7% compounding, that's 40 extra bucks in your pocket, that you wouldn't have had otherwise. If it's 20 years, it's $80, 30 years, $160. So this is all, in theory, kind of free money, right? So it sounds pretty good. But even let's say you do have to pay taxes on the $160, let's say after a couple of decades of compounding. Well, you'll pay taxes on that, right? However, you were able to grow that money much more than $20.
Yeah.
So
yeah.
That extra benefit, most of it is growth at that point.
That's a great illustration. It's like, even if we say, okay, it's going to be a 25% tax rate, like that 20 growing to 160, even if you paid $40 in taxes, you're still up 120.
Right.
You've generated $120 of kind of free money on letting that $20 grow and pay taxes in the future. So again, no step in basis, same tax rate. That time value of money part, even though it's kind of really subtle and it's hard to kind of understand, that might end up being the most powerful part.
Yeah.
That just not paying taxes now and letting your money continue to grow, even after you pay tax in the future, because again, assuming tax rates are the same, that's going to be where that growth comes from. That's going to be where those significant benefits come from.
Right. Yeah. And again, it's even better if your tax rate's low in the future. It's even better if you get the full step up in basis.
Yeah. Yeah. But again, even in our example, even if your tax rate's 35% now, it's 25% in the future, so you're getting a 10% savings. So you're saving $16 on our 20. Step up in basis, you're saving kind of that $40 tax bill. Where you don't pay capital 25%, so you pay, so you're saving $40 on 160. That still is less than just the compound growth. That we made you $120 So we went from 20 to 120. So we made an extra. No, this is $20 you would have paid in taxes. So yeah, you have an extra $120. That's still more than our fictional step-up basis tax avoided and our potential reduction in tax rates.
Mm-hmm. Mm-hmm.
So actually, that's even. I hadn't really thought about like doing the math of that, but yeah, that's even stronger than I thought. I thought the step-up in basis would be the more powerful impact. But yeah, I think you're right. Just of having that money now in your pocket and saved and invested and growing is because even like when it comes down to like the personal habits, even if you spent that tax savings, it kind of implies you didn't spend money from your investments or you had extra money to save somewhere else. That part is still growing. So like you don't have to take money out of your investment account to pay a tax bill, or you don't have to take money out of your savings and pay your tax bill. So you have a little extra money of, okay, I got above my cash reserve. I have this extra to invest. And like most people don't see that direct tax savings equals more investments growing, but there's enough kind of other factors between how much we keep in cash, what's your savings rate, that if you aren't spending that money on taxes, a decent chunk of that will kind of trickle over to your investments, especially if you're working with an advisor.
Yeah, right. It's one of those things where, again, just the ability to defer taxes ends up being so powerful over time.
So this is totally off to the side. I have been kind of having like a internal thought exercise, but it's same concept. If you have maxed out your IRAs, 401ks, and I think the idea came to me like if a company allowed you to make after-tax 401k contributions without a Roth conversion, so you don't get a tax deduction on the money going in, it does grow tax deferred, but it's taxed as ordinary income in the future. Is that tax deferral better than putting the money in a taxable investment account, which theoretically we could get long-term capital gains in the future?
And why can't you convert it to the Roth?
Some plans don't allow that. Some 401k plans don't allow. But like if you make too much and you can't contribute to a Roth, it's almost like you would do the first half of a backdoor Roth. You're making an after-tax IRA, and you forget to convert it. So something like that.
Yeah. So basically, is tax deferment but having to pay ordinary capital gains better?
Ordinary income.
Sorry, on any gains better than having to pay capital gains, but you get to do tax loss harvesting and everything else.
Yeah.
You would do in a taxable account. Frankly, it depends on a few things, right? Well, what is your marginal tax rate when you retire? If it's going to be still pretty high, without doing too many on-the-fly back of the napkin analysis, I feel like it's going to be kind of Moxnix. I don't think I see a major benefit either way.
Wait. Say that word again.
Moxnix.
What's that?
I gotta Google some Moxnix definition. It's MOXNIX.
Is that like a 6 of one, half dozen of the other kind of thing?
Oh, it might be. It's from like the 40s, so.
It sounds Latin.
I don't know. It's under dated slang. So. I don't know if I'm dating myself here, but it basically just it doesn't matter or irrelevant.
Wow. Okay. Come for tax loss harvesting. Get dated. Not just slang. Dated slang.
So apparently it originated from a German term called Machnichts. which was brought over by U.S. soldiers after being in Germany during World War II, and they turned into Muslims. So, anyway,
Sorry. Okay, so um, I totally caught off guard by that. Okay, so yeah, the tax deferral, but paying. I think you're right. Like tax rates in the future matter a lot to this kind of calculation. And so let's say if their ordinary income tax rates stay the same.
I would go with the taxable account.
I think so too. I think that was my conclusion as well.
Yeah, and I was going to say here's why. With a taxable account, in theory, my strategy is buy and hold anyway.
Mm-hmm.
So you're already approximating what you would get pretty closely what you would get with a tax deferment, right?
Yeah.
So if you're going to tax defer anyway with a buy and hold, and then on top of that, you get to do tax loss harvesting. And then on top of that, you have a lower tax rate, the capital gains rate versus the marginal income rate.
Yep.
I feel like you're at a winner, So depending on the strategy. Yep.
I have kind of one caveat to that, but I have the same conclusion for a slightly different reason. Even if you had that S&P 500, you're still going to get like dividend income. So you're still going to get 1.5% taxable each year. So that's why I think that's one of those things that I agree. Most likely I'm going to buy and hold the same thing as well. I'm not going to have capital gains taxes, but I'm going to have that little super tiny dividends being reinvested that are taxable. But sorry, go ahead.
Yeah. So, well, actually, to that point, so basically, back of the napkin math, about 80% of your growth, I'd say, is capital gains growth, which is deferred, and about 20% would be like dividend growth.
Yeah.
So, compare that though with the lower tax rate you get, right? The lower capital gains tax rate, the lower dividend tax rate as you go along. And at the end of the day, I think you're not so bad off with this, because also, for example, with my clients, I follow a asset location strategy where if something's throwing off a lot of dividends along the way or growing very quickly and has a higher tax burden, I would probably locate those in the retirement accounts anyway.
Okay. Yeah.
So all else being equal, I don't see too much benefit, with the tax deferment only option.
So it's actually that flexibility idea. That's another big factor that comes into just my clients' lives of having that money in a taxable investment account. Again, assuming that there's no genuine tax benefits, like again, that after taxes are earning income in the future, it's a lot easier to access before age 60. There are ways to do it in retirement accounts. You can do contributions to Roth accounts. You can do contributions that after tax. You can do systematic equal periodic payments, or starting 55. There's different ways to get out, but having that money to kind of use for whatever you want at some point in the future, that kind of flexibility, maybe you're wildly successful and you're looking at buying a vacation home. It's a lot easier to get that down payment for the vacation home out of a taxable investment account than it is a retirement account. It's easier to pay for that big vacation. So like that flexibility of having that money that you can use sooner, it kind of outweighs the Moxnix tax calculation.
Yeah.
I don't know if I used that correctly.
You can go watch 1940s war movies and probably catch a few others, but I think it's even worse. For example, you won't get the step up in basis opportunity either. So I think we've come up with enough evidence saying that on the surface it may look about the same, but I think that scales are tipped in my mind to sticking with the taxable account.
Yeah, you'll have RMDs in that because it's not Roth. It's gonna be all ordinary income, so like it affects other Yeah, like you have less control. Yeah, I think you're right. There's enough downsides if you're not getting a tax deduction or it's growing tax deferred, tax free, and Roth, then probably taxable will be better.
Yeah.
Yeah.
Right.
Okay. Well, thank you for helping me kind of think through that, because I had been making that recommendation, but I couldn't quite narrow in on, is that genuinely optimal? But it sounds like kind of the math side is pretty close either way. It's going to be just that flexibility and aspect. And yeah, step from basis would be awesome.
Right.
So.
Right.
Still chuckling, like, come for the tax loss harvesting, learn dated slang. Anything else you want to add in terms of tax loss harvesting or dated slang?
Well, I'll stick to the former. I'm no expert on the latter, but I have a few other insights on the former. So there are actually a handful of gotchas as well to keep in mind when you're tax loss harvesting. It's just more reasons why this is just so tricky to pull off in practice, even though it sounds nice in theory. For example, you got to be a little careful. If you sell that S&P and lock in that loss in the taxable account, be wary about immediately buying it in the next 30 days in your retirement account.
I've asked CPAs about this, and I believe this is an unsettled gray area.
Yeah, it is. And you can imagine there's a conservative approach and there's a more aggressive approach.
Yeah.
And I think most clients, or I don't want to speak for most clients, but I feel like the conservative approach might be sensible when gray areas like this come up in many situations. I don't know, was that hedged enough?
Yeah, we're not CPAs. We're not providing tax advice. It could come up in an audit. But I think CPA, they don't know how to even be tracked, but it would have to come up in an audit. But yes, it is under current tax law. It's written that if you sell out of a taxable account, realize a loss, and buy in a retirement account, you own both stock in both situations. That could violate the wash sale rule.
Yeah. And, just even thinking more laterally, if you sell it and then your wife buys it the next day, well,
yeah, yep.
Right? So you might have to be wary about all of your accounts and what happens in this 30-day window. In fact, it's a 60-day window. It's 30 days before and 30 days after. For example, you can't buy the S&P yesterday in your retirement account and sell it today. So
loss in a taxable account.
Yeah. So basically, you need to have a good idea of what's going on for the past 60 days or within a 60-day window across all of a client's accounts to, ensure that they're indemnified against this particular concern, which again, it's not black and white, but it's something to be cautious about, especially if you want to take the more conservative approach.
So it sounds like you're advocating for esoteric sub-accounts in 401ks to make sure that you don't accidentally buy and sell the same Vanguard ETF or Vanguard index fund.
Well, yeah, I mean, luckily 401ks end up having mutual funds, mostly, and there's hopefully enough difference between the mutual funds that are offered and the ETFs that we would do this in, so that it's not so much of an issue. But, again, just got to be cautious, right? And it's just easier said than done. So that's one gotcha right there. The other gotcha is to do this properly. And we mentioned this in the previous episode on tax loss harvesting, you got to keep track of all the different tax lots. And when you go to make the sale to lock in the losses, you have to specify, well, this deals with tax loss 1, 17, 27, and 39.
Yeah.
And you got to make sure that's reported properly, right? And often trading tax loss in retail accounts, I don't know if it's so easy, right? I think you have to actually specify them and follow up, right? Whereas the institutional software we use, the idea is hopefully that's handled more in an automated fashion.
Yeah, it's one of those things, like, be careful of your custodian. Like, make sure your custodian's tracking the individual tax lots. Like, that's not a safe assumption across different custodians.
Yeah.
And again, it comes back to like, there's definite work there, and the custodian needs to be able to track this. Custodian needs to be able to make money to stay in business. If you're not paying the custodian anything, they're probably making money from like order flow and cash spreads. So like, this is important. You can't, it's really, really difficult to do it yourself. You're probably going to have to pay for it somewhere.
Yeah, I think there's enough little things to make this so, frankly annoying or hard to pull off with just a calculator, that if it isn't a pretty simple situation, it can easily spiral out of control.
The one client who wanted to do this themselves, we eventually settled on, I think they liked a Bogleheads article about like a 3-fund portfolio. So he's using Vanguard Total Stock Market, Vanguard Total International Stock, and California Muni Bond Fund. And it was that kind of like, I put together an asset allocation of large cap growth, large cap value, small cap growth, small cap value, international emerging markets, a couple of bond components. And like, he could do the tax loss harvesting, but again, his idea, he wanted to do it himself. He wanted to understand it. He wanted to learn. He wanted to have that control, and something, just keeping it simple ended up being a better route. So he has definitely foregone some tax loss harvesting benefits. He's gotten some, but not as maxed out as he could, in exchange for simplicity and control.
Yeah, I mean, another, as you were saying that, another gotcha that just came into my head, like, let's say you sold out of the S&P, you bought the Russell, and now like 2 weeks later, you get a bonus check of like 10,000. Well, you got to remember, can't buy the S&P. You got to buy the Russell until you're ready to ship out of it.
Yep.
But, if you wait to the end, if you get to that end of that 30-day window, but wait, you just bought Russell, right? And now it's at a loss, and oh boy. Yeah. Buyer beware.
So again, in general, this is a good thing. You should do it. The tax loss harvesting, the tax savings benefits really does pay off. Okay. I recommend using a program to do it for you. And that's what I do with my own money. It's what I do with my clients. There are fees associated with that, but I think that the fees are worth it. But it's possible to do it yourself as long as you're careful. And it's like, one of the else I like about this is that you can actually screen out their company stock. So there's no transactions in the company stock. So as we place trades related to their company stock, we're not concerned about it being offset by activities of the manager.
Right.
So, okay, this is a fun conversation today.
Right.
I think you keep picking up all that old slang from your hedge fund days of like obscure financial terms from the 40s and 50s.
That could be true. All right. Well, good stuff, Aaron. I enjoyed the conversation. If you're listening to this and you've thought about running this type of strategy, or even if you've done it yourself and you have some more gotchas or maybe even some wins in this area, we'd love to hear from you about it. And, of course, thanks everybody for listening. If you're enjoying these conversations, do spread the word. We definitely enjoyed those likes, shares, and comments and feedback that you send us. Thanks, everybody. Bye.
Thanks. Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.